Well, good afternoon, everyone. Thank you for joining us. My name is Joe Bloodgood, and I'm a partner with Boulay Financial Advisors. We have for you today a presentation that we're very excited about. Jeff Kleintop is with Charles Schwab, and he's going to share his views on global markets, what to watch, what to expect, and potentially where to invest. Jeff has a slide deck of information he's going to go through today for about the first 40 or 45 minutes of our conversation. And then we'll reserve the last 10 or 15 minutes for Q&A. Just as a reminder, you do have a Q&A chat box through your Zoom connection. Feel free to use that throughout the presentation. We'll answer questions along the way and then again formally at the end for anybody who has them. To properly introduce Jeff, let me give you a little bit of his background. He's a Senior Vice President and Chief Global Investment Strategist at Charles Schwab. Jeff is responsible for analyzing and discussing international markets, trends, and events to help investors understand their significance and financial implications. He provides research, commentary, and actionable insights to Schwab's client-facing teams and the firm's investor services and advisor services clients. Prior to joining Schwab, Jeff was the Chief Market Strategist for LPL Financial. Earlier in his career, he was Chief Investment Strategist at PNC Wealth Management and Senior Investment Strategist at Aris Corporation of America. Cited in the Wall Street Journal as one of Wall Street's best and brightest, Jeff frequently appears on CNBC, Bloomberg TV, and CNN, and is often quoted in the Wall Street Journal, Barron's, and the Financial Times. Welcome, Jeff Kleintop.
Thanks, Joe. Thanks for having me here. This is a real great opportunity for me to share some thoughts, and please take advantage of what Joe talked about with that question, the Q&A format, because I'm really interested in what you're all excited about or want to hear more about or worried about. You know, we've got so many things facing us here, particularly over the next 3 months with regard to an election and the virus and, of course, economic developments, earnings, so many factors. I'll barely be able to touch on many of them, and I'd love to dive more deeply into those that are important to you. So definitely take advantage of that, and we'll focus on that in the latter part of the call. Now, I want to talk to you about what we see happening in the global marketplace right now, the economy, how we see that shaping up around the world, progress of the virus, progress of the economic recovery, earnings, and then policy decisions, and then taking that into investment takeaways. So what does it all mean for us as investors? And so I'm going to focus on that towards the end. But let me start out by taking us back in time a little bit here. Probably should have had this up during the introduction. Sorry about that. But let me take you back in time just a little bit to last year. This is the only time we're really going to look back. I'm mostly going to be focusing on looking forward here, but I think it's important to get that historical context of where we're coming from rather than just starting looking forward. And that's this single slide here looking backwards. This is the last 50 years. And the blue line is, gosh, if I had to pick one indicator for the entire global economy, I would pick this one. It's the composite leading index from the OECD. It's the Organization for Economic Cooperation and Development, big global think tank, been around many, many, many decades. And they put together leading indicators for the global economy for 45 different countries, but they do one for the entire world. And that's this index right here. And what I think is important about this is not what they focus on, which is when the index is over 100, the global economy is accelerating, it's picking up speed, and when it's below 100, it's slowing down. Got that. And if you'll notice last year in 2019, it was slowing down. That was concerning us. But when it's below 99 is what bothers me. And that's why I drew that threshold across the bottom. And this is what I had highlighted in my 2020 Outlook, published back in December, and why we thought that the global economy was vulnerable to a recession this year. For many reasons, one of which was indicated by this thing here. As it was headed down towards that 99 level. Earnings had slowed to a halt in most of the world, in Europe, in the U.S., and in Asia. And we were definitely seeing some weakness in the manufacturing sector and in trade for a variety of different reasons. So I was worried about this 99 threshold, and things started to pick up in January, and then boom, got hit by COVID-19. And we didn't know what the catalyst was going to be that may expose this vulnerability in the global economy, but but boy, it hit us hard and hit us suddenly. And you can see just that incredible drop in that blue line down to unprecedented levels. And it's been rebounding since. I haven't updated this for the latest number, but it's kind of getting back towards 99, which is encouraging. I only bring this up because we need to do better than 2019. We can't just get back to where we were in the global economy a year ago and say, whew, problem solved, everything's okay, because it wasn't okay. Trade was falling on a year-over-year basis. Manufacturing activity was in recession. We were seeing layoffs in manufacturing. Earnings had fallen to, again, zero. They're actually negative in the third and fourth quarter on a year-over-year basis in the U.S. and elsewhere. So it was not a great period of time. It wasn't quite a recession, but it certainly wasn't a period that we just want to go right back to. We got to do better. And that's the context I want to share the next few charts with you. We got to do better. And fortunately, we're starting to see things shape up a little better. We have seen a V-shaped recovery in much of the world's sentiment indicators and some of their output indicators. This is what I watch closely. This is the global indicator for services and for manufacturing, surveying purchasing managers at these firms who are kind of the first to see new orders when they come in because they have to order supplies and the like. So what you can see here is things were kind of cruising along and then really got nailed, but they've rebounded pretty much back to where they were late last year. That's good. We need to see more. We need to see a V plus shaped rebound here in a lot of these indicators, and some of them are shaping up that way. But the good news is we have seen this so far. Now, the problem with a V is it's also the start of a W, and that's what we've got to watch out for, right? We not only want to see this rise continue, we don't want to see it retrench. And that's the context that we need to be focused on with the resurgence in some virus cases and lockdowns in some parts around the world. We want to make sure that doesn't turn into a W. But I'm encouraged so far by what I'm seeing globally here in terms of this V-shaped economic recovery. We can see what it means for the economy here. So I showed you the composite purchasing managers index, the manufacturing and service on the other slide. Well, this is what they mean for GDP. And I'm going to focus on Europe here. Just the Eurozone's the biggest economy in the world. And so I think it's important to focus on. And just taking a look at that very V-shaped recovery here, what it means for GDP. It actually gets GDP back to maybe 2.5 or 3%, booming, but pretty good and better than what we've seen in recent years. So that's really good. We need to see this V or even V-shaped plus rebound in order to just get decent growth rates where we can get earnings to pick back up again and hopefully reward us with further stock market performance. Stocks have already priced in a good bit of this recovery. So in order to support those valuations, we need to see that continue and flow through into earnings. Now, the labor market is not showing these great signs of recovery yet. I haven't updated this for Friday's unemployment numbers. They were better. We're now down to around 10% unemployment in the U.S. And that's a lot better than the near 15% we saw just a few months ago. But it's still obviously very high compared to recent history. We got a long way to go. And that's a problem because right now, a lot of those people who are receiving state unemployment benefits, well, the average state unemployment benefit is only $333. So when they lost that extra $600 that they were getting from the CARES Act at the end of July, it's been a real hit to their income and ability to spend and support their families. So that may get reinstated with this executive order to some degree in a few weeks, or maybe there'll be a deal in Washington, although that really doesn't look like there's actually no scheduled meetings between the parties in Washington to move towards an extension of that. So a little bit worried about that. Even as employment improves, those people who are on unemployment are receiving less and less in terms of benefits. Fortunately, that's not true in Europe or in Asia. The social infrastructure is much more robust. So in most cases, they're getting around 80% of their income replaced. And that will extend all the way through next year. So they're in relatively good shape, but we're starting to see the unemployment rate rise there as well. You can probably barely see it on this chart, but it is ticking up a little bit. And we might see these two numbers come together around 9 or even 10% in the coming months as things begin to rise in Europe, even as they begin to fade in the U.S. So definitely something we're focused on here. Can't take for granted that this is going to turn around. Probably be quite a few years till we get employment back here in the U.S., and that's going to remain an issue with an economy that's driven 2/3 by consumer spending. So we've got to focus on that very closely. Now, what we've done is we put together heat maps for every one of the major countries around the world to track on a real-time, on a weekly basis, how well these recoveries are taking shape. Now, we started doing this earlier this year to kind of track this activity, figuring that it would take a while before monthly or quarterly economic readings would kind of confirm where we're at. So I'm encouraged to show you this. This is for Germany, and I'm bringing it up because it's the biggest economy in the Eurozone, but most look like this. If we look at Japan, if we look at France or Italy, the US doesn't quite look this good, but most look like this, where in the early part of the year, things were looking pretty good. They were green. They're starting to improve again. And then, of course, we hit the COVID lockdowns, and you see all that red. And I'm going to point out what I'm really highlighting here. The top line is the number of COVID cases. And they really peaked out there, spiked up very quickly in early April, and as the shutdowns went into place. The next line below that is from Oxford University. It's a measure of how shut down the economy was. They call it the stringency index. And some economies were shut down way more than others. For example, Germany shut down a lot more than the US. The US didn't really have a national shutdown. Some states shut down, some didn't. It was applied more aggressively in some than others. So it just varied around the world and even across states. But here you can see in Germany, it was pretty strict, and where that shutdown kind of peaked out over the course of April there. But then below that is where I want you to really focus, which is air pollution, which is our proxy for manufacturing activity. Nobody likes air pollution, but we know it coincides with manufacturing. When manufacturing picks up, we get more air pollution, localized air pollution. And so it's good to see that has improved. It's picked back up again as factories have reopened. We've seen on the very bottom line there, electricity demand coming back online. That's encouraging. Retail sales, actual people going to stores and shopping. And that's what we're seeing there in the second to bottom line. Whoops. On that chart. And then commuter traffic in the middle, that's people getting back to work. And then the line that's taken the longest to turn around is going to the movies. We look at a lot of different things, but I'm highlighting on this weekly box office numbers. We've started to see most places around the world, we haven't opened them in the US yet, but most places around the world have reopened their movie theaters, and we're starting to see that come back. In fact, Japan, the numbers are back to where they were a year ago. So, people willing to gather for entertainment purposes in groups is a real sign of confidence that the peak in COVID-19 is behind us, and reflected in consumer and business confidence as well, and therefore showing up in earnings. So we're starting to see that in a number of these countries as well. So that's why I bring this up. Now, the latest week, a little softer. That's because Europe goes on vacation in August. They just shut down. And so I don't seasonally adjust these numbers. So we're going to see what we see as we go through August and people go on vacation. Fairly normal. But we'll be watching that. But not seeing any real backtracking that I would worry about a W shape at this point, a return to the lows. That would mean stocks would have to give up their gains. Not seeing that kind of thing yet. But on a weekly basis, maybe a little bit of a moderation in that early pace of recovery we saw, let's say in May, when things really bounced back as they began to loosen those restrictions. So let's focus on the COVID for a moment, the virus epidemic. These are charts you've probably seen. This is the global number of new cases, which has continued to rise, although it started to level off. But more importantly, I think what the market has been focused on is the number of deaths. And you may hear about the number of deaths or the cumulative number of deaths in kind of a headline shocker way, but we track them on a daily basis, the daily number of new deaths by country around the world. And here we've aggregated them. And if you take a look at the stock markets in many countries, they've tracked the deaths data, not the cases data. And deaths peaked out generally, around late March, early April, and have improved since then. Not in a linear way. I mean, one of the things that's keeping this up is India and Brazil and the US, where we have seen an uptick in the number of deaths. Mexico, a few other places where they really haven't been able to contain the COVID outbreak or the number of deaths. But for the most part, the world has. And that's one of the reasons why the market's not reacted negatively to the rising case count, because they really focused on the mortality, seeing that as more of a signal of, whether people are going to self-isolate again. and step back from spending, shopping, and going on the limited vacations they've been going on here, as we've seen people starting to go to Disney World again, how they would pull back from that, whether businesses or individuals even self-quarantine or states have to shut down. More tied, I think, to the deaths data there than to the cases data. So that's what we're most focused on. Obviously I'm worried about this. I can't predict this. Were these two lines going to climb again, I would worry we would be headed into a W. But the fact that the deaths haven't ticked up is encouraging to me, and that the case count we've seen is not entirely, but largely due to better testing and wider testing and testing of younger population, and not just the at-risk older population, which seems to be taking appropriate precautions and keeping the death count down. So I don't know where this is going to go. I'm not trying to predict it. I'm just saying this is important to watch. It's the deaths more than the cases on a daily basis I think you want to stay most focused on. I think that'll be tied to policy developments and, of course, the markets. What it means for earnings as we connect all that to stocks is really important. And this is two, obviously mirror images of each other. This is the number of companies getting upward or downward revisions to their earnings estimates by analysts. So this is the MSCI World Index. I wanted to show you a really broad measure looking around the world, but 2/3 of these companies are US companies. So this looks the same for the S&P 500 as it does for the whole world, if you're wondering, how it looks for the US. And what you see there is the orange line are downward revisions. And boy, did they spike. Obviously, just a tremendous number of companies getting downward revisions. And in fact, in April, the only companies, that blue line there indicating we're getting upward revisions, were really in the healthcare area, or, Zoom, or a few others that were really tied, kind of COVID winners, if you will, getting upgraded. Everybody else was seeing massive downgrades. But that has completely turned around. And now in the last week or two, we've started to see more companies getting upgrades than those getting downgrades for the first time since February. And that has really helped to support the markets in the face of somewhat elevated valuations, at least in the US. As long as earnings momentum is improving, we're seeing estimates rise. The number of companies getting upward revisions is going up and up and up. That can support higher valuations. Remember, valuations often snap back very quickly in recoveries. They often, the price to earnings ratio will jump right back above where it was before the downturn happened, in part because the earnings base is lower and stocks have recovered a lot of those lost. That's not unusual to see the price to earnings ratio rebound very quickly. What's important to see it sustained is this, a real turnaround in the underlying momentum for earnings. And I'm encouraged by what we're seeing there. And here you can see how it's lined up with stock market performance. So that blue line is this blue line on this chart. Here it is, just zoomed in. This is the number of companies getting upward revisions, and the orange line is the stock market. It's not a perfect match, but I don't think you'd see any kind of match if you didn't see that, I don't think you'd see any improvement in the stock market if you didn't see that blue line going up, if you didn't see some kind of fundamental improvement in the outlook for earnings for the stock market. I don't think you'd see stocks improving there. So I think there is a connection. People often say, hey, how can the stock market be going up in this horrible economic environment? People have lost their jobs. Companies are filing for bankruptcy. Why is the stock market so cold-blooded? But of course, it's looking forward rather than at the present environment. And as our analysts, as they look at their earnings targets, and that's where the connection is. The stocks are always looking ahead, and they're looking to a brighter future. Now, one of the reasons they see a brighter future is this, the guardians of the economy. These are the heads of all the major central banks. We've got Jerome Powell from the Fed, Christine Lagarde from the European Central Bank, Kuroda over in Japan, Carney at the Bank of England. They have pulled up all of the stops. In fact, they've done unprecedented movements here to provide liquidity to the markets, and it's working. I mean, based on financial conditions, businesses are not having trouble borrowing. Even junk bond companies are not having trouble borrowing here at all. I mean, some are issuing at 3% interest rate. So it's working in that businesses are not being cut off from capital and being forced to shut down and lay off employees. They may be doing that because of business prospects, but they're not being forced to because of the capital markets. The Fed is insured, and other central banks, that they can function, that businesses can borrow in this environment. It's a function of their business prospects, whether they want to or not. The other thing that's happened is fiscal stimulus, right? Actual mailing out checks to people, making loans to businesses, getting money pumped into the economy in an unprecedented way. This chart just blows my mind. So this is the percentage of stimulus, both monetary stimulus from the Fed and fiscal stimulus from the government, in terms of the CARES Act and the like, as a percent of GDP. In Germany, it's 60%. I can't even, Germany usually doesn't run a budget deficit. They usually run a modest surplus. For them to run even a 1% deficit would blow their mind, right? This is 60% of GDP. I mean, it's in the aftermath of the global financial crisis, the whole world put together somewhere around 4 or 5% of GDP in terms of global stimulus. On average, the world right now is somewhere around 30%. I'd say 6 times, maybe more than 6 times what was put in place in the aftermath of the great financial crisis. Oh, and by the way earlier than what was done with the global financial crisis. So just an enormous amount. And you can see it here. It's Germany, Japan, Italy, France, Canada, the U.S. is in there. I mean, just enormous amounts. Less in China, in part because their recovery is actually pretty much fully intact. They're pretty much fully recovered already. They were hit in the first quarter already. They just released their auto sales numbers. They're up 10% from a year ago. I mean, they've completely recovered in their economy from the COVID recession. And we can verify that with a number of third parties. I'm talking about not just Chinese reported statistics, but what Ford and GM are telling us, what Daimler-Benz is telling us, what Toyota is telling us, what export data into China is telling us from Korea and other countries, data that we trust. We can't always trust the Chinese government's data. And it's verifying that they're fully back. So the amount of stimulus they're applying is much lower. That doesn't mean their economy isn't doing well. The exception here is the UK. The UK needs this, and they don't have it. Not only are they going through Brexit right now, or the post-Brexit environment, trying to figure out what their trade relationship is with the EU. Whoops, sorry about that. They're not able to apply as much stimulus as other countries. And their central bank isn't doing as much. And they really haven't gotten their arms around COVID-19. In fact, in the last couple of weeks, they've seen the number of new virus cases tick up. So I'm really worried about the UK here in this environment. I think there's a lot of risk there, and they're not doing anywhere near enough. Other countries may have done too much. I don't know. We'll see. It's early to say, but there's an enormous amount that's been done. And what this means in terms of inflation, we'll have to see down the road. We got the purchasing price index, or the PPI, to the producer price index today in the U.S., and it blew away expectations. A big surge in prices. We'll get the consumer price index, I think, tomorrow here in the U.S. Last month was the biggest increase in the CPI in 10 years. We could see another one of those for this past month as well, for July. So real turnaround in inflation and inflation expectations we're seeing in some of the data as a consequence of this. Maybe that worked. Maybe we finally got rid of the deflation worries that have plagued us for so long, but that's one of the consequences of this. The other is a lot of debt. And when are we going to pay this back? How are we going to pay this back? What's it mean if interest rates start to move up on that higher inflation? Can we afford it? I don't know. It's probably the biggest risk to all of this. Right now, not a risk. Interest rates are extremely low and remain low. But down the road, we've got to worry about this as a consequence of this. Certainly, it's needed now. Not begrudging it at all. But the question is, what does this mean long term? And the jury's out on that one. And it could look something like this. Tremendous amount of stimulus this year, kind of pushing the economy along, kind of chasing us. And even next year, all that debt, and even the impulse, just the fact that we're not adding more stimulus next year could mean that we feel a little bit of a hangover. Not that this is a party, but we may feel the effects of less stimulus next year. Already the unemployed in the U.S. are beginning to feel that, and that could weigh us down a little bit with that debt. So I do worry of things, at least in some countries, slowing down next year as a consequence of this. But we'll deal with that problem as we come to it. One of the things that we most want to focus on is the leadership in the markets, and this translates into where I think the investment opportunities are. This has been a very different recovery in the stock market. It may feel pretty typical. Stocks usually bounce off of their lows similarly to what we've seen in the last 3 or 4 months. But the way they've done it is different. A lot of it's been done on defensive stock leadership. What are defensive stocks? Well, they're ones that aren't sensitive to the growth in the economy. They're like healthcare companies that kind of do well no matter what's going on with the economy. And many of them were winners when it came to COVID. Some tech stocks really benefit from us working at home, right? Defensive leadership really defined the first month or two of this rally. You can't build on that. Markets in the past have always been market recoveries have been led by cyclicals. So if you look back here, the last 2 big bear market recoveries back in 2009, 2002 were led by cyclicals. This isn't what the market did. This is what cyclicals did relative to defensive. So meaning companies in the industrial sector or the financial sector, very sensitive to what's happening in the economy relative to those that are not so sensitive to economic growth. Usually, boom, they come rocketing back. Not true this time. The blue line is this time. And we started to see some movement there, but it's leveled off in the last month or so. We need to see renewed momentum in more economically sensitive stocks for this rally to have legs. You just can't go too far on defensive leadership, I think. Well, at least we haven't in the past. And so I'm watching this very carefully. This means leadership in more value-oriented stocks in those sectors like financials. We recently upgraded the financial sector for the first time in maybe a decade. And we took down about a year or so ago a weighting in tech to a market weight from an overweight. So noting that shift and expecting more of a value-oriented marketplace and more of a movement towards cyclical stocks here on this rally. So hoping to see that continue here and sustain the rally. But let me take this back to what I think this means longer term, and then we'll get to your questions. I'm going to kick it off here with just a brief look at this chart. If you've seen me present before, then you have seen this chart before. This is a chart I've been using for over 20 years now. I just keep updating it. It's the yield curve. Got a lot of attention last year as the yield curve did what we call an inversion. All it means is just long-term interest rates fell below short-term interest rates. Very unusual when that happens. And that's what the blue line, the dark blue line, is depicting on this chart. It's the spread between long and short-term interest rates. So when it turns negative, long-term rates are dropping below short-term rates. Again, very unusual. And I've marked every time that's happened in the last 50 years with an orange dot. And those orange dots precede those gray columns, which are recessions, by about a year. But they coincide with that top blue line there. They kind of coincide with peaks in the stock market. So they're real important to watch out for. And so last year in our 2020 outlook, we looked at the yield curve inverted and that global leading indicators headed lower. I think we're vulnerable to a recession, but that wasn't the main message. The main message was we're even more set up for a rotation in market leadership, something that most investors miss. If they don't have the benefit of professional advice, as you all do, working with Boulay, they miss it. And we see it at Schwab all the time. They look back years later and realize that they should have changed their investment strategy or rebalanced their portfolio back to underperforming areas of the market. And they didn't do it. They didn't have the discipline to do it, and they miss out. Let me show you what I mean by that and why a diversified portfolio really makes sense right now, more than any time in the last 10 years. So I want to show you this international versus US chart. And I've taken it back all the way back to the early 80s because I had to show you a period where international stocks outperformed the US as much as US stocks outperformed international stocks over the last 10 or 12 years. And so what I've done here is just set up a chart with the relative performance of international versus US. When the blue line's going up, international stocks are outperforming. And when the blue line's going down, they're underperforming, and vice versa with that orange line. So the orange line, when that's going up, US stocks are outperforming. So if you look back to the 80s, international stocks were all the rage, led by Japan. Japan was the place to be in the 80s. They were taking over the world until 1989. Then we got to that blue line there. Now that's not shaded gray. It's not a recession. This is the periods where the yield curve inverted. Remember I marked them with that little orange dot? Well, this is the period where that blue line was below zero. And what it signified was a change in the market, that we were headed into a recession and we're headed into a change in market leadership. And what we saw was a shift from international outperformance to US outperformance. And that happened again in 2001 and again in 2007 ahead of those recessions. And it's just happened again. In the last 3 months, we've started to see international stocks outperform US stocks for the first time in about a decade. And I think it's a sign that we're starting to see a rotation begin to unfold. As this happened every time. So I've taken you back to 83. I could take you back 50 years. Every time we get one of these yield curve inversions and recessions, we get new leadership. It flip-flops between US and international stocks. The magnitude of outperformance isn't always the same. It varies, as you can see here. But the leadership definitely shifts. And it shifts between growth and value stocks and large and small cap stocks, but it also shifts between international and the US. Now, it's so easy to have left the international part of your portfolio dwindle to basically nothing over the last 12 years because it's underperformed the US. But that, I think, about to change and already changing, and why it's so important to have a globally diversified portfolio right now, because I think those stocks could begin to lead the market. Just looking at valuations right now, from our perspective, I just published a commentary on Schwab.com that points to maybe returns for international stocks over the next 10 years, somewhere around 10%, which is okay. Not bad, right? But US stocks might only be 3%. It's still positive, but quite a bit lower. And that same kind of gap in performance that we've seen between international and US stocks over the last 12 years. Now, that's by no means a guarantee, but it would just be the historical patterns we've seen over the last 50 years playing out again in terms of the extreme valuations that we see US stocks are at versus international stocks, and the expectations of earnings growth versus international stocks. All those things that build up over a long cycle of outperformance begin to reverse as we go through one of these recessions. So I think we are on the other side of this now, and we're starting to see new leadership emerge. So probably beating that to death, but I think it's a really important point. And this gets to the return numbers I spoke to. So this is if we take a look at the valuations of stocks and what they tell us about future returns. I think a lot of people worry, hey, aren't valuations a little bit high right now? Shouldn't be worried about the near-term direction of the stock market. No, I don't think so. Valuations usually jump back pretty quickly in a recovery ahead of the recovery in earnings. It's the long term where valuations take their toll. So what's on this chart, the orange line is the price to earnings ratio, valuations for the stock market. If you're a big follower of the stock market, people talk about the PE ratio all the time. What I've done here is I flipped it upside down. Why did I flip it upside down? That's the scale on the left. Because higher valuations, the more you pay for stocks, means the lower your returns in the future. And that's what the blue line is. It's your future returns. All I did was just take the next 10 years of return and shift it back 10 years to see how the current PE tells you what your return is going to be over the next 10 years. And it's worked out really well. 10 years ago, this was pointing to really strong double-digit returns in the US stock market, and we got them. But now look where it's pointing. Somewhere between 0 and 5%, maybe 3% returns going forward, kind of lackluster. Could be wrong, and there's certainly room for variation around this, right? We've seen it in the past, but it's not a great sign given where valuations are. But here's the bright side of this. Here's the international picture. This is what we're, there we go. Here's, that was just a longer term, So longer term perspective here. This is going back to 1935. This is just zooming in from 1973 to now to see it a little more closely. Same scale. Here's international. And in recent years, it hasn't tracked as closely. We had some developments with regard to the global financial crisis, kind of threw it off track. But I think over the last couple of years, once 08, 09 kind of rolled off the 10-year window, this is synced back up again. What it's telling us, valuations right here where they are pointing to maybe a 10% rate, somewhere between 8 and 12% or 6 and 12%. The opposite of what we saw over the last 10 years. Look, 10 years ago, the PE was telling us you might get something around a 5 or 6% rate of return. It's exactly what we got. So looking now, a brighter outlook for international stocks versus US stocks. 10 years ago, this was telling you the exact opposite. So I just bring it up because I think people are just not thinking about it. They've kind of left international out of their picture here. And one of the important reasons why we always talk about globally diversified portfolios. So I know I've beaten that to death, but I think it's an overlooked message. People are so focused on the overall market. Is it going up or is it going down? What's Apple doing or what's Alphabet doing or what's Facebook doing? And I think the more important picture is this shift to international leadership that many investors are going to miss out on a very important element of a diversified portfolio. So let me sum this up. Watch the deaths. I know it's morbid, but I think you can ignore the case counts. More case counts is actually good news because it means we're testing people. COVID deaths are what you want to focus on. Hopefully they don't tick up. Watch those heat maps. I publish them every week on my Twitter and LinkedIn feed. It's at Jeffrey Kleintop. You can find them on there. They're there every Monday. I update them every week. And watch the policy response. We need to see a renewed CARES Act in the U.S. in order to sustain the kind of support we've seen in other countries and continue this recovery. What to expect is volatility, that's for sure. Over the next 90 days, we've got an election. We've got increasing U.S.-China tensions probably. We've got back to school for COVID, and we see what happens there. We've got the flu season coming back. So all those factors are going to be a big issue here for the markets. And then think about that international picture. Whenever we get a new cycle, we get new leadership, shift from growth to value, large to small, and international and U.S. So that's very important here from a diversified perspective. So Joe, wrapped it up there. Let's see. I'd love to hear what thoughts or comments or questions folks have.
Yeah, thank you, Jeff. That was certainly great information. I think we all got something from the discussion. Let's look at a few of the questions, and I would just encourage everyone again, if you haven't already, feel free to enter your questions in the Q&A box. We'll get to as many of them as we possibly can. Jeff, there seems to be a theme in the questions around how does all this debt get resolved ultimately, right? The massive stimulus you spoke about. What's sort of the end game there, and how should investors be thinking about that?
I don't know. I wish I had a great answer to that question. What I can say is we can look at Japan for a real world example that's leading us on this. Japan has many more times debt to GDP than we have in the U.S. In the U.S., somewhere around 100% of GDP in terms of government debt. In Japan, it's 250. And their economy is, growing slowly. Their taxpayer base is shrinking. They're dying off. Their population's been shrinking for 20 years. So how are they dealing with it? Well, they first dealt with it by adopting zero interest rates. In 1999, they decided they had to do that to deal with this debt situation. It's been a long time, and they've been able to sustain it. And then about 10 years later, they did quantitative easing. QE, to try and bring down longer term interest rates so that they can continue to sustain all this debt. Well, it worked. Everybody else followed that lead. Maybe Japan will come up with something else new and the rest of the world will follow that path. Or maybe they hit a wall somehow. Maybe they run out of demand for debt. And maybe they suddenly start to see interest rates rise and are forced to do something with their devalue their currency or something. That's probably the most likely outcome is a devaluation in currency. But let's watch Japan, because I think they're the canary in the coal mine on this. Already we're starting to feel some effects in the US. One of the reasons why the dollar has fallen 9% in the last 2 months is because of all this debt we're piling on. We need to borrow a lot more from the rest of the world in order to do that. We're pushing a lot more dollars into the world's financial system. And so, that the consequence of supply and demand is it pushes down on the dollar. So get used to that, a weaker dollar, not just in the near term, but over the next several years. That's our base case view here at Schwab. And I guess a consequence of that from an investment perspective is think about international, again, whether it's international fixed income or international equities, because those gains likely translate back into more dollars. I wish I had a longer term answer for you here and how we deal with all that debt, but I don't. And we haven't yet seen a country that's been able to deal with this burden of debt successfully.
Thank you. Yeah, thank you. It seems like another theme that's on everyone's mind is obviously the election. You've alluded to that. And I think there's maybe a sense, you spoke about volatility in the near term. How do you view an election within the context of an overall financial or investment plan, particularly a long-term one? Is it an event? Should it be planned around, or is it ultimately a sort of a blip on the radar screen?
Well, history tells us that it's the markets and the economy that more often than not dictate the outcome of the recession of the election than the election kind of dictating what happens in the markets, right? So it tells you a lot. So, going through a year where we've had a bear market and a recession tells you a lot more about the poll numbers right now, then the outcome of the election, I think, is going to shape the markets. That said, within the market there can be factors, right? So I think people say, well, what about the change? Or what could change? A Democratic sweep, meaning that the Senate would change hands, could mean some sweeping legislative changes were Biden to take the White House, and they could potentially be negative for heavily regulated and legislated sectors like energy and financials. Those are two perennial targets. But on the other hand, it could be positive for green energy stocks, could be positive for infrastructure companies, engineering and construction, for example, as it might be more likely to see big infrastructure spending program under all Democratic government. But it's hard to say. Those are at the margin. I think overall, were we to see gridlock there's an expression, gridlock is good. And from the market's perspective, it is, because it means less sweeping legislative changes on things like taxes and major developments that would impact businesses' future plans. And so if we still see the Senate remain in the hands of the GOP, the White House has relatively limited influence in terms of those sweeping changes. And the market probably wouldn't make too much of that. It would certainly look at the U.S.-China relationship probably differently. Biden has emphasized a multilateral approach to dealing with China, much like the TPP, the Obama administration championing the Trans-Pacific Partnership to try and get China to agree to certain things. Ultimately, they didn't, but to try and encourage them to do those things in a much more transparent and again, inviting a lot of countries along. It's a long process as opposed to a tweet in terms of trying to effectuate change. So I think the markets, maybe their concerns ease a little bit over the U.S. and China. Not that the issues go away. Still plenty of issues between U.S. and China in terms of technological leadership, in terms of environmental concerns, labor issues. But the way in which they're addressed is very different and maybe less anxiety around them in the market. So those are a couple takeaways, but I think you set it up well, Joe. It's more of a blip from a long-term perspective in that the markets tend to dictate the election outcome more than the election outcome dictates the markets.
Yeah, absolutely. Thank you. You've spoken, at length on this call just about where you see potentially an opportunity in international markets. And I think for most people, that's pretty broad. Would you care to be any more specific? Are there areas you think are more attractive than others?
I hesitate to be more specific. And the reason is different countries behave like different sectors of the stock market. I'll give you an example. So the US, from a global perspective, you look at the US stock market versus the rest of the world, the US behaves like a tech ETF. If you put the U.S. stock market and a global tech ETF on the same chart, it's one line. Japan behaves just like a financial. Not because financials are the biggest sector in Japan, by the way. That's consumer discretionary. Companies like Toyota and Sony. It's just that the way businesses are set up, they own shares in the banks and the banks own shares in the companies. Everything acts like a financial. It literally looks like a financial ETF. Germany behaves like an auto stock. I mean, it's so tied to autos. It's remarkable. Switzerland really behaves like a healthcare company. You got Roche there, and so very, very tied into to what's going on there from a healthcare perspective. In fact, about 40% of the stock market in Switzerland is all about healthcare. I give you a bunch of examples. France behaves like an industrial. The UK is a bit more like an energy stock. And so rather than say, look, I think you should pick this country or that country because its economy is doing better, we need to recognize that the countries in certain economies around the world have a global marketplace, right? So Toyota, yeah, it's a Japanese company, but I don't care what's happening in Japan's economy, right? Because they barely sell any cars in Japan. They sell way more, 90% of their cars outside of Japan they do in Japan. So what difference does it make? What really matters is what's China's car market look like, right? That matters to GM and Toyota almost equally. So I think we need to recognize they have a global customer base, and the fact that different countries behave like different sectors just means you need to own a lot of them. So rather than saying, yeah, you need to own Australia because it behaves like materials, Canada because it behaves like energy stock, Japan because it behaves like a financial, this and that and the other thing, why not own them all in terms of a broad exposure to a mutual fund or an ETF that really covers broad international exposure that includes Asia, that includes Europe. I'm less excited about Latin America. Most of South America is emerging markets or frontier markets anyway, and a relatively small weighting. Most of the even emerging markets, 60% of that is in Asia. It's China and Korea make up about half of that alone. So I think even when it comes to emerging markets, you can buy a broad ETF and still feel pretty safe that you've got a good mix of companies and countries that are actually giving you broad exposure. So that's why I tend not to break it down. I know it sounds very broad, but to break it down, really get sector by sector. And then you risk being underexposed to you have all the risks of concentration.
You bet. So a few more questions I think are interesting. I think we have just a couple minutes left. There's some thought. I think there's probably a few people that are on the call that are still acutely aware of the last recession in 2008 and 2009 and the role that housing played in that. I've heard more and more conversation around, with where interest rates are, anecdotally, at least, it seems like housing is still quite strong, at least in our part of the country. Are there any concerns at the national level about another housing bubble, or is that overblown?
I think where there are concerns about housing, it's in the cities where they're concerned people aren't going to go back to work. Everybody wants to move to the suburbs, but generally, no. Look, housing tends to only have problems when banks won't lend. It's not even about interest rates, really. It's not about the cost of borrowing. It's the ability to borrow. And if people can't borrow to buy homes or commercial properties, prices have to plunge. That's not the case this time, in part because the banks are way, way better capitalized than they were going into 2008, but also because the Fed's made sure that they have cheap capital, and other central banks have made sure their banks have very, very cheap capital, flush with reserves. They are super willing to make loans right now. And that's the key, not only with interest rates low, but banks willing to make the loans. Very different environment for real estate. I have been holding some cash, kind of hoping to buy that vacation property when things dipped. I don't think I'm going to get that chance.
Yeah, absolutely. Let's talk just a moment here, going back to the topic of COVID. There's some questions around a vaccine and the impact that might have on the market. As you've seen the market sort of make that V-shaped recovery, let's think optimistically and let's say we see a vaccine materialize early in 2021. What impact do you think that might have on capital markets?
I think the biggest impact is you can expect to see those entertainment and travel, tourism related stocks come roaring back. The airlines are still pretty much pinned to their lows. They would come back in a huge way. And I think you probably see that around, hotels and a lot tied to that. It's a lot of employment that's tied to the service industries, even more than stock market capitalization. So I think you see those stocks lead, but I think you'd see a lot of those jobs come back. And that will be really important in turning around the consumer spending picture. And there are a number of countries like Greece and Italy very tied to travel and tourism in general. So that would be a big plus there. And that's probably the biggest impact you'd see. I think for people talk about the long-term consequences and I don't know. I mean, more people have found they can work at home and be effective. I remember after 9/11, the idea was everything was going to change. No one was going to travel anymore. People were going to move out of cities. There were a lot of lifestyle changes that were suggested. And while our lives did change in a number of ways we couldn't foresee, in a lot of ways, things did get back to normal. And I think that may be the case again this time. So I'm more focused on, I think you'd see a lot of the jobs come back more quickly for sure. And that would be great. And less need for support and extended benefits. And then you'd also, I think, really see those stocks that are still lingering near their lows come back in a more robust way. That's probably the trade. I think a lot of those stocks are just waiting for that antiviral or vaccine announcement to pop here. And that's probably the biggest takeaway we've seen in the market.
Thanks a lot, Jeff. Well, I want to just thank everyone for your participation today. I want to especially thank Jeff for the great information he shared with us today. For those of you who are not familiar with Boulay Financial Advisors, we provide comprehensive wealth management to individuals, families, and institutional investors. We talked a lot about the markets today and the role investments play, but we see your investments within the broader picture of a comprehensive financial plan. Our job is to help you make decisions around your dollars and your money that are in line with yourself and your family and your institution's goals and dreams. So if we can be of any help, please reach out. You can email us at learnmore@bouleygroup.com. Again, learnmore@bouleygroup.com. Again, thank you, Jeff. We appreciate your time.
My pleasure. Thanks, everyone.